Welcome to a basic strategy in trading binary options. This topic is brought to you by binaryoptions.net.au. Every trader at every level of experience in every market seeks a trading strategy in which achieves just one single outcome: profit. And even the most advanced traders with advanced strategies begin trading with just one basic strategy. For binary options traders who are not concerned with how much an asset moves in price, only direction, a basic strategy which succeeds in achieving consistent returns along with a high probability setup can be easily found and applied for trading profit. Before discussing any strategy, irrespective of trading difficulty, it is important to master the trading basics. These basics include key markets, shares, forex, futures, commodities, index markets, options, and so on. Price and volume charts including chart types, basic chart patterns, recognizing increasing and decreasing volume levels, etc. Market trading hours. Exchange trading hours differ throughout the world, so it is important when selecting the market to trade that trading hours are considered. Forex markets are an exception. They are traded 24 hours a day. On this subject, a trader's calendar should also be included in every trader's book. Exchange holidays and expiration dates are very important to know and trade accordingly. A trader should also have a basic knowledge of technical indicators available, such as charting tools. Technical indicators can be used to identify changes in volume, trend, momentum, volatility, and when used as trigger points, are effective in generating profitable trading signals. A trader should also know the difference between a long and a short trade, and for binary options traders, a call and a put trade, as well as risk management techniques and strategies. Once the trading basics are mastered, a trader must consider the type of trader they consider themselves to be. That is, are they a long or short-term trader, and are they interested in trading multiple times throughout the day or simply weekly or monthly as suitable opportunities arise? Broadly speaking, there are four main types of trading: day trading, swing trading, position trading, and investing. Day trading, which often carries the most risk, is when shares are bought and sold within the one day. Referred to as intraday trading, traders can place multiple positions on various markets throughout the day, seeking to achieve small but multiple increments of profit. When traders predominantly follow a short-term trend, either upward or downward, and hold their open positions for between 2 and 14 days, they are considered swing traders. Position traders work on larger time frames of between 1 and 6 months, while investors are considered long-term traders who seek to capture long-term growth and profit with receipt of dividends. So as a binary options trader, what is it we are seeking in a basic strategy? We are seeking a high probability setup. That is, a trade or trade direction which we believe has a very good chance of expiring in the money. A high probability setup includes identifying key price action levels, including the price series, high, low, open, close, support and resistance levels, applicable trend lines, trading volume, and price direction. So what basic strategy can we use which has a high probability setup? We trade the gap. Gap trading is a simple and effective price pattern strategy for trading both call and put binary options. The gap is a price pattern, not a technical indicator, which is observed on a daily price chart whereby a stock's price closes at one price but opens the following day at a higher or lower price. A price gap is the result of after hours and pre-market trading, which occurs when the market is closed. Prices trade up or down during these times, and at market open, a price opens at its most recently traded price. A price gap occurs for many reasons, but most often because of regular or irregular pre-market activity, news announcements, asset earnings, acquisitions, and so on. Price gaps commonly appear on daily price charts, but also on minute, hourly, and tick charts, as well as weekly and long-term charts. It should be noted that a price gap is rarely seen in the forex markets since it is highly liquid and trades 24 hours a day. Price gaps often occur during intraday trading periods. However, a high probability setup for binary traders occurs when a gap is as a result of change in price levels between the close and open of 2 consecutive days. For the overnight period, there are 4 basic types of price gaps. 1. Full gap up, that is, when the opening price is greater than yesterday's price, and 2. Full gap down, when the opening price is less than yesterday's low. 3. Partial gap up, when today's opening price is higher than yesterday's close, but no higher than yesterday's high. And 4. Partial gap down, that is, when the opening price is below yesterday's close, but not below yesterday's low. For binary options traders, the most basic of gap strategies is to trade the overnight price gap, which is both high probability and can be used to place call and put trades. To prepare the price chart for a trade setup and to identify entry points, a trader must draw a horizontal line at yesterday's close and when the market opens at the open price. The objective of the strategy is to fill the gap. This occurs when price retraces back to the previous day's price levels. The strategy itself is simple, using a candlestick chart on almost any time frame. When the open price is lower than yesterday's closing price, a call trade is placed. When the open price is higher than yesterday's closing price, a put trade is placed. At market open, if the price opens higher than yesterday's close, it tells us that the buyers are in charge with the market seeing value in higher prices. However, yesterday's close acts as a price magnet, drawing prices downward, and in anticipation of the retracement, binary options traders should place a put trade. Conversely, if at market open the price opens lower than yesterday's close, it tells us that the sellers are in charge with the market, seeing value in lower prices. However, yesterday's close acts as a price magnet, draws prices upward, and in anticipation of the retracement, binary options traders should place a call trade. In both cases of an opening price breakout, traders are seeking confirmation that price will fall or rise back into the trading range of the previous day. So we ask, will the gap always be filled? We must answer this statistically and say, this depends on the average size of the opening gap. Defined as a function of the prior day's range, when an upside or downside gap exceeds 40% of the prior day's range, then approximately half of the opening gaps will not fill during that coming day's price action. However, when the upside or downside gap is less than 40% of the previous day's range, up to 80 to 90% of the opening gaps will fill during the coming day's price action. Put simply, the odds are considered high probability for a binary options trade where the gap is equal to or less than 40% of the previous day's range. For more information about this topic and more binary options trading strategies, please visit binaryoptions.net.au.